Also notice that we are in the lower portion of the range defined by this high and this low. So we're in a real low area where it would be deemed oversold. So we have a range concept blending with the fact that we're moving back in the middle of a smaller consolidated trading range with a market structure break of recent high in here, broke that high, and it came back to equilibrium. So the highest probability in terms of direction is going to be going short or going long. Well, obviously it's going to be going long, but the mechanics behind it was that the fact that we broke this swing high, we have this void in here, okay? We had weakness in the dollar, which we're not going to talk so much about correlation between dollar-based analysis, but we're only specifically dealing with price action alone here. But what led to this bullish move in the Aussie dollar this week was the fact that we moved back into fair value or equilibrium. So that way, it's fair value for the market makers to build in long positions or build a net long book. That means they're accumulating long positions. The down candle right before this move up through a short-term high, that is a bullish order block. So price comes down into that, hits it. At the same time, it's hitting at equilibrium, and it's deemed fair value. It's fair value because the market traded back down into an area where it wants to be bought again and where it should be expected to see buying pressure come in. We don't want to buy it up here because we've already broke a swing high. What are we doing up there? We would be buying at a premium. That's not what you want to do. So you're going to blend a couple things when you're looking for high probability setups. To get fair valuation, you're going to be looking at the current range from high to low. In this area right here, we're in the lower end of that range. So we have a lot more upside to build in a premium, like we just discussed in the previous tutorial. Okay, market will go to a premium. Okay, the market's buying at a discount. Okay, and it's at equilibrium. It's at fair valuation because we're in the low end of the range from this high to this low. And we have all of this open price action right in here. So the market's going to want to come up there and close that in. It doesn't have to come all the way back up to this candle's low, which is a bearish order block, this up candle right before the down move. All this is needed to give us a directional bias. We have a swing high in here where we know what's going to be resting above that. Buy stops. So we know that there is a strong likelihood that because we're in the low end of the total range, which is this low to this high, so this is the parent price swing, this high to this low, we created a short-term low that was higher. We broke through a swing high, came back down into the equal distance of the high to the low, that is equilibrium. We are now at fair valuation. For what? For longs. The market makers can build a net long book at this price level. Now, if they're going to do that, they're going to look for fair value above the marketplace, where they can do what? Sell their positions at a fair value for them. Up here, if traders are buying this chasing price, are they buying at a fair value? No, they're buying at a premium. Remember that we just discussed in regards to equilibrium to premium, the range from this high to this low, we're above 50% level, and here we're in that upper portion of the optimal trade entry, or 62 to 79 cent trade cent level. I'll show you what that looks like.